Read the title of this NBC article. Welcome to the housing market's new normal. 7% mortgage rates and all. Now, if you're a weirdo like me and you're wondering what is this and all, let me show you. It means a low inventory of homes for sale, and it means high home prices. So what it's saying is welcome to the new normal housing market where you have mortgage rates at or above 7%. You have not that many homes available for sale, and on top of that, you have home prices that are still extremely high. Now, the reason why this is so interesting is because we have a lot of people also saying that the housing market is going to get more affordable in 2024. And the question is, how? This is from Greg McBride, who is the chief financial analyst at Bankrate, and what he says is, if you get that promotion in 2024, you pay off your student loan debt, you really build up your savings, you're going to be in a position where home prices may not be much different 2 years from now than they are today, but your financial position is a whole lot better. Now, if you're confused, let me diagram what that means. If we back up a little bit to the beginning of 2021, the median house in the United States was selling for around $371,000. If you went out and you bought this home for $371,000 and you put 20% down, that means you'd be putting down $74,000 to buy the home. Now, in 2021, you could go out and get a 3% mortgage, maybe even under 3%, but let's just assume you got a 3% 30-year fixed rate mortgage. That means your monthly payments on this $371,000 home would have been $1,250 a month. Now, if you've watched any of my housing market videos before, you might have heard me talk about things like this before, but this is where the analysis generally stops. But this is where, if you want to take a look at housing affordability, you have to add in one more factor, which is the household income in America, because in 2021, the median household income in America was around $70,700. Now let's compare this to 2023. In 2023, that same median home in America was selling for $435,000, which meant if you put 20% down on this home, you'd be putting down $87,000 as opposed to the $74,000 a couple years prior. And you couldn't get a 3% mortgage in 2023. You were going to get a 7% mortgage in 2023, which meant the monthly payments on this home in 2023 would cost you $2,300 a month, while household income in America grew from $70,700 to an estimated $76,000. This number hasn't been confirmed yet. We're still waiting on this data, but it's an estimate. This is where it's pretty easy to see the problem, because now you can see that the median home price in America grew by 17% over these couple of years. And the monthly payments on that same median home in America grew by 84% in just a couple of years, while the median household income in America grew by just 7.5%. So yeah, home prices and monthly costs rose a whole lot faster than how much money people were making. Now let's fast forward to 2024 to see why this is so significant. In 2024, the price growth is really expected to be pretty negligent. Maybe a couple of percent of price growth in 2024. Some neighborhoods are expected to actually drop in price, but in general, it's kind of expected to stay the same. So home prices might not grow that much in 2024. In some neighborhoods, they might actually fall, so it kind of negates. And mortgage rates are kind of expected to stay around that 7%. Maybe they'll drop later in the year, but we really don't know. Right now, they're still at the 7% number. And if mortgage rates stay at 7% and home prices are right around the same, that means you're going to be paying around the same $2,300 a month. Maybe it'll be a little bit less, maybe a little bit more, but it's kind of around the same. But the hope is that maybe household incomes will grow from $76,000 to an estimated $80,000. Now you can start to see why economists say that homes are going to be more affordable in 2024, because people will make more money while home prices and costs haven't really changed. Now the problem with that is, sure, maybe on paper it's slightly more affordable, but the problem is you're forgetting about this massive run-up and this massive run-up. A few percent increase in monthly income does make a home more affordable, but the problem is home prices and monthly costs have risen so significantly that it's still extremely unaffordable. So maybe it's just less unaffordable, for a better way to say it. Not to mention that this is where the article says that people also had the ability over the last 12 months to also work to build up some savings and pay down some debt, to have some more wealth in addition to this higher income, to be able to go out and hopefully afford this home. Again, affordability is very relative because you want to take a look at the broader picture, which let's do that now. We're going to jump back into our show in just a minute, but first, the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage rates at no charge charged to you. There are multiple lenders competing on Credible's marketplace. So if you're thinking about getting a mortgage, you can compare great rates from different lenders and then pick the option that's best for you. The process is simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes. And then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use and it only takes a few minutes. So if you want to learn more and see what mortgage rates you might qualify for, I got the link to how you can do that with Credible down in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So again, if you want to learn more and see what mortgage rates you might qualify for, I got the link to how you can do that with Credible down in the description below. And with that, let's go back to the show. The reason why affordability is so subjective is because we're seeing these kind of two polar extremes happen in our economy right now. On one hand, you have more and more people that are struggling with their credit card debts. We have a record amount of credit card debt in the United States. You have millions of Americans that cannot afford to make the student loan payments, and you also have a lot of people that are balling out on their car payments in America that can't afford their cars, that are struggling to make those payments. So you have a chunk of America that's going more and more down this extreme, and then you have the other extreme where some people have become extremely wealthy over the last few years because the stock market has been breaking new record highs. We saw Bitcoin break a record high, and we're still seeing housing and rent prices extremely high. On this end, all this is great news for the financially educated. It's very good for the investors, the people that knew that they should be investing their money. But it's not so good for the people that are not financially educated, that have not been investing their money, that don't know how to invest their money. So you're seeing this bigger divide in affordability where the people that have been investing their money are seeing their wealths rise, while the people that haven't been investing their money are becoming poorer and poorer in this economic system. This is where now you're seeing a growing number of people that are hoping that mortgage rates will fall. Because if mortgage rates fall, your monthly payments will fall. And if your monthly payments will fall, housing will become more affordable, and people on this side of the extreme, the people that have been getting hurt in this financial system, are going to have more ability to hopefully buy a home. But there's two things I want you to understand about this. Number one is, when will mortgage rates actually fall? And number two is, what would the impact be of the lower mortgage rates? Will it actually make homes more affordable? So let me start by talking about number one, when will mortgage rates fall? The Federal Reserve Bank has been pretty transparent that they are not ready to start cutting interest rates yet because they're not sure what the real trajectory of inflation is. Now, that being said, the Federal Reserve Bank has said that they're still planning and hoping to start cutting interest rates in 2024, but we really don't know when that will happen. Now, despite that being the case, I want you to also remember this, that over the last couple of years, the Federal Reserve Bank had to raise interest rates 11 times to get interest rates to where they are today. So even if the Federal Reserve Bank were to cut interest rates a few times in the next 12 months, this still doesn't mean that mortgage rates would go back down to 3 or 4%. Because it was 11 interest rate hikes that got us to here. If the Federal Reserve Bank cuts interest rates 3 times, that still means that interest rates are going to be elevated. So you want to remember that part. But the second thing you also want to think about is what is going to be the impact of lower mortgage rates. And we've talked about this in market briefs, where every time you see those small dips in mortgage rates, what does that do in terms of potential home prices? Now, Market Briefs, for those of you who don't know, is a free newsletter that my team at Briefs Media publishes every day. It is a free and easy to read breakdown of what's happening in things like the housing market, the stock market, crypto, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, if mortgage rates were to fall, interest rates fall, mortgage rates fall, what is going to happen to the housing market? Now, in the short term, housing would get more affordable. Because now when you go out to borrow those $400,000, instead of paying 7%, you'd pay 6% or 5% or 4% or 3%, which means you're paying less interest on that money. But if mortgage rates go down to, let's just say, 3 or 4 or 5%, what else is going to happen? You have all these buyers who want to buy a home that are sitting on the sidelines that are going to say, oh, you mean that it's going to cost me less money every month to own the $500,000 home? Let me go and call up my realtor to see if we can make an offer as well. And now you can have a lot of people that were kind of sleeping on the sidelines wake up and come back into the housing market, because there's a lot of people that want to buy a home that are just kind of sitting on the sidelines right now. And if they start calling the realtors to see what homes are out there, well then pretty soon everyone's going to say, well, my mortgage payments are going to be so much less, so maybe let's bid a little bit more. Instead of bidding $500,000, which is the asking price on this home, maybe let's bid $530,000 or $550,000 or $580,000 or $610,000. Because if you remember a couple of years ago when mortgage rates were low, lots of people were bidding six figures over asking price for homes because everybody just wanted to get a home. And if mortgage rates fall at a time where people are still sitting on the sidelines, people still have the ability to buy, people are still waiting to buy, that's going to wake up a lot of demand, and then that's going to push a lot of people to want to make offers. And if home prices go up again, well then that pushes us into the second layer of dilemma, which is, well, if home prices are rising, that makes the inflation problem worse. And if the inflation problem gets worse, that poses another issue for, well, the Federal Reserve Bank. Because the reason why the Federal Reserve Bank has been waiting to cut interest rates is because they're worried that a cut in interest rates could trigger another spike in inflation. So you can start to see how this is a conundrum. The Federal Reserve Bank wants to cut interest rates to keep stimulating the economy, but they're worried that if they cut interest rates, people will start spending more money and the prices of things are going to go back up. This is why the Federal Reserve Bank is kind of waiting and hoping to see what's going to happen in the economy. Because if we start to see more of a slowdown in the economy, if we start to see more unemployment, if we start to see more layoffs, that's good in the Federal Reserve Bank's eyes because that gives them the ability to stimulate the economy by cutting interest rates. And if that happens, well, that also means the economy is hurting and the people don't have the incomes and that maybe less people can go out and buy a home. That's what they want to do. They want to reduce demand. So while that sounds good in theory, the interest rates would fall. In order for the Federal Reserve Bank to cut interest rates, they have to see a change in the economy and they have to see a change in unemployment to justify these lower interest rates. Because if the Fed were to start cutting interest rates today, the inflation problem would get worse next month. And this is where the Federal Reserve Bank is trying to juggle this, and that's why they keep saying that they're expecting unemployment to rise in 2024. Now, of course, no one knows what will actually happen. The Federal Reserve Bank has been wrong many times before. They even said that inflation was transitory. Remember that? Well, this is where it pays to pay attention. That way you can make smart financial decisions and not just jump into things, not make emotional decisions, but rather make financially smart decisions because you want to be a financially educated investor, not an emotional investor. And that starts by understanding the ways that a housing market works. Between 2008 till 2012, we were in a buyer's market. Buyers had the upper hand because there was a lot of sellers, but not that many people were buying. And if you go back around the 2002 to 2005 time, well, that was a seller's market again, because that was when you had a lot of buyers who wanted to buy homes, but not that many sellers that had homes that they wanted to sell.